Peace, 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 family. Your boy Treetop Chris checking in, and today we're going to talk about something called a death note. Well, a mortgage note. That's what we call mortgages in the financial world. We call them death notes. Why do we call them death notes? Because the interest rate on them is outrageous. And I'm going to do an example, and I'm going to show you a calculation how you can get exactly how much interest you're going to pay over 30 years. Now, getting a house is a great investment if you know what to do with it, or if you want a place to live, to call your own. It's not that bad. You just got to figure out how you can kill the interest fast. And that's what I teach people how to do. But let's get to the calculation. So say if you bought a house that was $250,000, right? 250 bands. Somebody hit me on TikTok. 250 bands, right? We're going to do 6.25%. So how do we turn 6.25% into how much interest you're going to pay over 30 years? So you take 6.25, right? And you times that by 2. You get 12.5, right? But that's not it. So you got to add a 0. So it's 120.5. 120.5. What is that as a percentage? 120.5. On your phone, you hit the percentage button. That's how it looks as a percentage. So what you do now, you take that times 250. This is how much you're going to pay over the life of the loan for interest at 6.25%, $301,250 in interest over the 30 years. And we add that to the original principal balance of 250. That's how much you're going to pay total on a 6.25 interest rate over 30 years on a $250,000 home. Now, if I walked up to you and said, look, I'll sell you this house for $250. And you say, all right, cool, I'll buy it for $250. And then I turn around and say, I need you to pay me an extra $300,000. I'm like, what do you mean? You just told me it was $250. But that's how mortgages work. Let's do another one. So we're going to do one for $450,000, right? $450,000 at 5%. Same calculation. So we do 5 times 2. What's that? That's 10. Duh. All right. 5 times 2 is 10. But remember, we got to add a 0. So it's really 100. Right? So we take 10, add a 0, hit the percentage button. It's going to come out the straight 1. So 1 times 450,000 is 450,000. Duh. But we got to add our principal balance in plus 450,000. On a $450,000 mortgage at 5%, you're going to pay $900,000. It's crazy, right? That's why we call them a death note. But look, we teach our clients how to pay off 30-year mortgages in 8 years, 14 years, depending on how aggressive you want to be. In that process, we usually save between 70 and 90% of the interest across the life of the loan. But I just wanted to do that quick calculation so you would have something to do when you're going out and buying houses. Even if you're an investor or if you're a regular consumer, just know you take the percentage, times it by 2, add a 0, change it to a decimal, and then times it by the whole amount, then add the whole amount. Sounds kind of complicated, but I just did it for you. Just rewind the video or, run it back and you'll get it. But that's the death note, ladies and gentlemen. I hope you caught all that. Your boy Treetop Chris checking in. Peace and love.